Okay, in this video we'll be doing a cash flow exam type question for 40 marks. So 3.1, right? How much money does a business generate or utilize? Now, whenever your bank balance at the end of your cash flow, it's positive, it means it's utilized, which is used. If you have a positive, negative. If you have a positive, it'll be obviously generated because you have a positive. Now the formula is very very easy. Bank balance at the end minus bank balance at the beginning will give you your net cash. Your cash generated during the year, right? So the cash at the end, if you look in your notes or your financial statements, so end of the year 2023 bank is 221573. So you got that minus the beginning figure. If you look at the beginning, it's zero, right? But whenever they say zero, sometime bank may be in overdraft. So if you go more down, bank is in overdraft, so it's this. But you have to think very critically. If bank is in overdraft, bank is a negative. So when I say opening balance minus ending balance, it's technically the 221573 minus this, right? Because this is a minus. So that this turns to plus. So that and that plus that equals to that. So the formula n minus beginning is equal to cash generated during the year. And obviously it'll be generated because it's positive, right? This is negative will be utilized. So that's 3 marks. 3.2, they want cash received from customers. Now whenever you do this question, right, there's a couple things you look at. You look at the sales if there is sales. You look at the bad debts if there's bad debts. You look at trade receivables. You look at unearned income, which is income received in advance. Now, why do I say all this? Your sales figure doesn't represent cash because we're doing cash flows according to accrual basis. Sorry, the income statement is done with the accrual basis. So that sales figure we have, right? It doesn't mean that whole thing is cash. So you have to do all those stuff over here around it to make it a cash figure. The first thing I like to see is my trade receivables, right? Trade receivables, and a lot of ways you can do it. I don't like to do it this way, like opening trade receivables minus closing trade receivables. I like to get that amount one time and do my calculation, because this minus this will give you like your figure basically. So my trade receivables went from 2022 in the beginning of the year to 52,917 the end of the year. You have to ask yourself what is the difference. So let's work it out. 52,970 minus 51. I'm doing the odd in any difference, so whether I get a positive or negative, it doesn't matter. I just want the difference. Difference is 1362. Okay, then you gotta ask yourself, did it increase or decrease from the beginning? It increased. If your debt is increased, that's bad. It means you never get that sales figure portion. So your sales is actually going to decrease. The cash that you got from sales is going to decrease. So you write negative 1362. But obviously, this does make sense because minus this plus will give you minus 1362. Right? But yeah, you can do that that way, my way. Just put it over the trade receivables and that final amount minus 1362. You come to the same answer. Or you can just say plus the opening balance of trade receivables minus the closing balance of trade receivables, right? Both will work. Then the next thing you need to know is your unearned income. Now, unearned income is income received in advance. Income received in advance is basically income that you got in the business. Now, this income that you got in the business is cash. Cash came in the business, right? It was for the next year. So according to the accrual concept, how the income statement is done, your sales figure won't actually reflect as cash because the sale was for next year. But it's still cash that came in. So if you look at the unearned income, it jumped from 20,000 to 24,000. So that means you have 4,000 increase in income received in advance. So 4,000 cash you had come in, right? So very easy. You can just go over here and put plus 4,000 under income, right? So this is same thing. So just took out the opening balance and negative plus 24 will still give you 4,000 at the end. So another way to remember it, the beginning balance of unearned income, that means that was from the previous year. So you basically minus the opening balance because that there's no cash came in. But then during the year you got a cash there, so it's plus 24,000. Or you can just state plus 4,000, put it one like unearned income plus 4,000, literally, right? That's what I like to do. Then the next thing you see is your bad debts, right? Bad debts, let's see, they tell us over here. Net operating cost is same as operating expenses. Bad debts. Now, bad debts now, it's where a debtor, right, buys something but doesn't pay the debt. So, if you really think about it, you never actually receive this money. The reason why we put it over here is that you think of the journal entry for bad debts. Debit bad debts, credit trade receivables. In our calculation, we did trade receivables here, right? So technically, when we say when trade receivables are in this calculation, debit bad debts, credit trade receivables, we're going to take the bad debts and minus it from trade receivables. So you can just go bad debts and put minus 4,500. Another way you can think about it is the sales, right? He never received that cash for that sales because it's bad debts at the end of the day. He's not paying. So whenever you see bad debts, just put the minus and whatever the amount they give, minus 4,500. The next thing what you want to do is check your bad debts recovered. That's good. That's a positive figure, as you can see, because that means you got that sales now. So cash came in now. Bad debts, person who was owing you money, who you thought was bad debts, came in the business and gave you money. So basically everything now you just add and you get this figure here. That's your cash received from customers, right? Another thing, if you had accrued income is income which you should have received this year but never. If you work at the difference, for example, if it was 20,000 at the beginning, at the end of the year it was 25,000. It had increase of 5,000. So if you had an increase of accrued income of 5,000, how does this affect your cash? According to the accrual concept, accrued income, you have to add it to your sales. So yes, you never have received the cash, but according to accrual concept, your sales will increase more than 5,000. But that's kind of messed up because you never get the cash for it. Accrued income is income which you should have received, but never. So when you go over here, you'll put minus 5,000, right? That's just a heads up if you have accrued income. So yeah, that's 3.2. Now 3.3, let's go. Okay, so 3.3, 30 marks. And this can be a little bit complicated, but it's not that complicated if you think about it logically, you know? So you always start with the net profit before tax. Now they say operating profit. Operating profit is net profit before tax. Operating profit basically means your gross profit minus operating expenses. That will give you net profit before tax. So the way you got operating profit is your gross profit minus operating expenses. This is operating expenses. That will give you your operating profit, right? Also known as net profit before tax. But because it did it this way, you can just put operating profit, huh? So you take this minus this, and obviously you get your operating profit. However, this operating profit right now, it's not in cash form. So from here all the way down till here, you have to change this figure to a cash to this figure. So this figure is actually the cash figure of this figure. So you have to do a bunch of calculations. Now, how do you know if these two like comes over here and if these two goes over there? Very simple, huh? The way I think about this, so firstly, trade receivables, inventory, and trade payables will always be there under working capital no matter what or not, right? The way I know prepaid unearned income is over here and not over here, it's very simple. You have to think about it logically. Over here is just in like income and expense, like dividend income, loss on sale are all income and expenses that are non-cash items that you have to remove from there. For example, depreciation is an expense. If they told you depreciation is included in the net profit, where's the net profit over here? In the net operating expenses, sorry. Then you'll actually say minus depreciation. Because that depreciation, you'll take it out from this operating expense. Because that was not an expense, a cash like outflow. So you have to minus the depreciation. Now, I'm just thinking 1 second, depreciation. Do you minus the depreciation or do you add? Depreciation. Let Let me think. Yeah, you minus, because this is the operating expense. So if I tell you my expense is, for example, 100,000, right? But it includes depreciation. Depreciation is not a cash item, so you have to minus it from that, because that'll give you now your cash, right? So basically now, what you have to do is very, very simple. Look in this over here and what affects the operating profit, right? Dividend income, you're going to put it over here, right? So because you're putting it in the bottom of your cash flow, it belongs over there. So because this operating cost expense is including dividend, you have to take it out from there. So to take it out is very, very easy. You just take out minus 12,000, right? Then your loss on sale of asset is a non-cash item, so to take it out from there, you say plus, right? Because the reason why, loss on sale, what will happen to your operating expense? It will increase the expense. No, sorry, operating expense. Loss. I'm just thinking the loss. Okay, 1 second. I think I made a mistake. When I tell you operating profit, right? It's actually your net profit. So sorry, it's not operating expense. This is operating expense. This is net profit. So technically, when I said depreciation, you have to say plus depreciation, right? Reason being is operating profit is net profit. So your net profit is all income and expenses. So to take out something, you just reverse. For example, depreciation, it's an expense. It's a minus in the income statement. So if I have to put my thing over here, I'm doing a reversal. So it's opposite. So it's going to be plus whatever the depreciation amount. Loss on sale is an expense. It'll minus the net profits. But now I'm reversing, so it'll be a plus. So yeah, sorry, this is actually net profit. So now that we got that straight, what affects the net profit over here that is not a cash item? So I said dividend. The reason why dividend we're taking out, it is a cash item, but we're taking it out here because we have to put it over here. Interest, dividend, tax always over here. Now we take the loss, because obviously the loss is not cash item. We say plus because that's the opposite. And some people will say, okay, what about bad debt expense or whatever? That will never put over here bad debt expense, because bad debt expense, although it's a non-cash item, technically over here you're gonna account for it because you got trade receivables. Trade receivables will already have that bad debt inside over there. That is why you don't actually do anything with it over here, right? Now, once we're done with that, we get the figure, we go on capital working changes. You'll always have inventory, trade receivables, and trade payables, right? Trade receivables, if you look at the figure over here in your balance sheet, has increased. More debtors, that's bad, so cash went out. So you minus the difference, right? Brackets, that means cash went out. Your inventory, however, has decreased. The only way inventory decreased in a shop is when you sell inventory, right? So that's actually going to be a positive figure because it's a cash inflow. Your trade payables, let's see. If your trade payables increase, that's good. Why? You don't have to pay the money to your creditor, right? So because it's good, you say plus. So 16,366. Now, how on earth we have all these unearned income, prepaid insurance? So you have to think critically about this. All those accrueds and all, you have to think really hard over here. Prepaid expense, an increase in prepaid expense. Now, they don't give you these figures here. So we have to work out prepaid expense, right? Now, let's see how we're going to work it out, okay? So, number 4, adjustment, right? So if you look at the workings, I will actually find it be easier if you look at the workings. So what we're working for prepaid expense is the opening balance, as you can see, there's question marks, and the closing balance, not the actual prepaid expense. We're working at the balance for 2023 and the balance for 2022. So to work it out, it's I never know it the first time too, so yeah. So to work at the opening, see, if you look at it carefully, right? How do they work at the closing balance? Right, so, On 1st of December, each year insurance amounting was paid. Okay. So 128,520. So basically, this whole scenario is saying you only pay for insurance once in the whole year, right? But this insurance that you pay is in December 2022 or any year, for example. But part of that amount you pay in December is going to go into the next year, so that will be the prepaid. Now, if you look at your financial year, that's your June. So if you pay in 1st December this full amount, what's going to be the prepaid? So December, January, February, March, April, May, June, 7 months is going to be in the financial year. You're fine. But the other 8, 9, 10, 11, 8, 9, 10, 11, 12, the other 5 months, what's going to happen? It's going to be outside the financial year. So you prepaid for those 5 months outside the financial year. So the closing balance, as you could see, we paid that. We just say times 5 over 12 is equal to 53,550. So at the year end, 53,550 is going to be the total 5 months after the financial year. Those 5 months combined will give you 53,550. Now critically think also, opening balance is going to be the same thing as the months 5 over 12, because every single year repeats year after year. The next year you paid for already 5 months, the next year you already paid for 5 months, because every December you're paying only one December, that's one payment for the whole of your thing year. So you'll always have a prepaid of 5 months, 5 months, 5 months, 5 months. Opening balance, however, is going to be different figure. 128,520 was a result of an increase of 5% of another figure. So you have to do solve. You can do solve for x, yeah. So basically, the way you do it, I just want to see if I take 128,520 and see how, like basically I had a figure before. I increased it by 5%. I got this figure. So now I have to do the reverse. So I'm thinking 128,520 divided by 105% will give me what the figure was before, and it was 122,400. That's the figure. There we go, 122,400. So times 5 over 12, because 5 over 12 is going to be the prepaid of the next year, and you get 51,000, right? So that is going to be the opening balance, right? So this opening balance right here, this closing balance is going to be over here. So if we can write it down now, so the opening balance is 51,000. So 51,000. Closing balance is 53,550. Always a prepaid all this. We're doing opening and closing balance, as you can see. Right, so now we increase now, right? So if we increased in prepaid expense, that means we paid money cash. So you'll put a plus in your of the difference. So plus of the difference. So what is actually the difference? So that minus that is 25550. That you'll put a plus in your over here. Oh no, sorry, outflow, because you're paying money obviously, so it's actually a minus because you're paying money, prepaid, you're paying for the next year. So yeah. Increase in unearned income. Unearned income jumped from 20 to 24,000. Remember, the other question we did was an independent question. It wasn't got to do with this question here, so we're not like doubling or something. That question is completely different to this question. Income received in advance jumped from 4,000, so that means we got more money cash, so plus 4,000. Done. All that now will give you total 336,024. Huh? Take this figure minus plus minus will give you that figure. Then after that, always, whether you're doing direct method, indirect method, after cash generated from operations, you'll have your interest paid, dividend paid, tax paid. Now, dividends, you can also say dividend received, dividends paid. Huh? Interest paid, interest received. But tax will just be tax paid. So dividends received, they told us over here, 12,000, so you just put 12,000. Then dividends paid, how do you get dividends paid? Very easy. Get your dividends declared, 58,000, as you can see over here. So I'm just going to the working. 58,000. Okay, so the way, okay, anyway, okay, oh, you can do it like this way. I want you to look at this 2,622 plus 10,488 plus our dividends that we declared, which was 58,000 that I showed you, minus 7,820 minus 31,308 will give you that figure. Done, literally, right? So it's plus this plus your dividends declared minus this is equal to your dividends paid. So all you do is now go there and put dividends paid in your thing. There we go. Dividends paid 32. Okay, outflow brackets. Let me do tax paid first. Tax paid. Tax paid 2 is quite, well, it's actually quite tricky. Okay, so tax paid. Tax paid is you need to get your net profit and then work out tax, huh? Now they're telling you something over here. The dividend income. Okay, so first I think you have to work out the interest, because you can't do tax paid without working out the interest. So let's do the interest on loan, right? So how does this interest on loan work? I want you to see the balance. Where's interest on loan? Or the interest on the loan, let's see. Okay, wait, why I did that? Okay, just look at that line there. Okay, so your loan jumped. Problem is you can't just say that was your loan. Thing is, you have to really look at the story, additional information, what happened over there, like why our balances did that. Okay, so let's see. So at the beginning of the year, you had a loan of 90,000. At the end of the year, your loan amount is 125,000. Something happened there. So your loan owing on 30th June 2022. 30th June 2022 is at the beginning of the year. So they're talking about the loan of 90,000. From Absa Bank. Okay, so that amount at the beginning of the year had an interest of 8% in arrears of the last day of each month. Paid in arrears at the end of each month. Okay. So at the end of each month you pay the interest. Half of the loan. Okay, and touch it and repeat half the loan. Okay, I get it. And raise a new loan. Okay, so if you can really think about what happened now, if you read this loan figure 90,000, right? So basically that was just living in your loan account. Then you paid half of the 90,000 of the loan, so your loan decreased. Then you have another loan. So if you look at the workings, right, you'll understand better. You paid. So when did you pay half of this loan? You paid it after the 10th month, so 11 and 12 months, so 2 months, huh? So the first 10 months you only had this 90,000 on loan, so to calculate interest at 8% times 10 over 12. Now if you read the scenario, it will tell you that you paid half of that loan. If you paid half of the loan, this balance will change from 90,000 to 45,000. So your loan now is 45,000 times 8% times 2 over 12. 600. This total right here will give you an interest for this loan that you had in the beginning of the year. Then also at the end of the year, you had a new loan. But what is the loan amount? Let's calculate the loan amount, right? Let's see what they did. Okay. So they said 125,000 minus 45,000. Why? Because this loan actually got reduced during the year to 45,000 because you paid. So if you take 125,000 minus 45,000, give you 80,000. That's your new loan that you have. Your new loan that you did was 2 months before the year ends. So 2 months only that you had that new loan. The times 12 times 6% is equal to 800. Add all the interest, you get to 74,400. And interest paid 7,400 in brackets because paid. Now let's do our tax. Reading the tax here, the dividend income earned, which is how much of dividend income, 12,000, is exempt from company tax. So this is extremely important. And half the loss on sale. How much is the loss on sale? 8,000. Is tax deductible. Okay. The formula if for this way to calculate your interest is you first have to get your net profit. You are basically your taxable like profits. So to get that, right? So to get that, you take your operating profit minus your interest expense, which you worked out in the previous question. That'll give you a profit before tax. Now, profit before tax. Now, after this, what you need to do is add like any exempt income or deduct any expenses that are not taxable. So basically, in this figure, profit before tax, you have to take out the income. So to take out, you reverse it. So income is a plus, but you reverse it, so minus. Because this income, it's not tax deductible. Right? Expenses you minus, so to reverse it, you plus. So you're basically taking it out from this figure here. Then you get taxable income. So this is how much money you need to get taxed. Time this by the tax rate, which is 28%. You get this figure. So this figure plus the balance in the beginning of the SARS account. So plus this figure minus the end figure will give you a tax paid 74,664, and you put 74,664 in brackets. Then what you do is add this number, add this number, and plus minus minus minus, and you get net cash flows from operating activities, and that is done. Yo.